You don't need money to make money. I've done over $20 million of seller finance deals. I've done over $20 million in syndicated deals using other people's money. Once you start exploring your relationship with money and understanding what money really is, money is just a tool. And the happiness that you derive from money is not the money itself. It's the autonomy that money creates. It's, hey, I want to be on a podcast with Peter today at 4 o'clock. I can do that because I have autonomy over my time.
You're listening to the Accredited Investors Only podcast presented by Accredited Life.
All right, Gino, welcome to the show. How you feeling today?
Peter, I'm feeling a little better than you did a few days ago, but it's the thing. It's lingering. My voice is off a little bit, but I'm doing much better. How you doing, brother?
I'm doing very good, and like I was saying, man, I feel like $1,000,000. Whatever I had it's still there. There's a little tinge of it, but I was joking to you beforehand. There was a moment there where I thought I might never be the same. Like I might feel like this forever. It's funny how things can change so quickly, right?
Peter, what I want you to do is I want you to hold on to that notion. I want you to hold on to that sentiment because your health is so important, and I think people minimize it. And it's just like anything else in life. You may have something today. When it's gone tomorrow, you really don't understand or appreciate it. And you really need your health to be successful in life. That's the reality. If you're not feeling great mentally, physically, you're feeling down, you don't have the energy, it's a lot harder to be successful or to put out the effort needed to become successful. So always keep that in the back of your mind saying, hey, I need to stay successful. I need to stay healthy to become successful for myself, for my family. And it will give you, I guess, the clarity, which will give you the motivation to continue to be healthy.
Yeah, it's funny you say that because you forget, and that was like I hadn't felt sick like that in years. I mean, probably almost since I was a little kid. Like it'd been so long. So to feel that way, the things that go through your mind at a time like that, it's really weird. I mean, it makes you think differently, and it almost puts things into perspective. There was times where I'm like jotting things down because it really kind of like puts the priorities. It shines a light on what's important to you and what's not. And then you start to say to yourself, if I ever feel better, that's what I'm going to do. I saw my mom was watching You've Got Mail with Tom Hanks the other day. And it was the scene in the elevator where the elevator breaks down. They're saying, if I ever get out of here, this is what I'm going to do. And it's when you have those moments in life. I mean, that it's fun. You got to ride it though. I mean, you got to stick with it. You got to keep that momentum going.
I agree.
Well, let's start with an introduction. I always like to hear people introduce themselves in their own words, and I know you got a lot of different things going on, all exciting stuff. So, Gino, let's hear from you. Who are you? What do you do? And why are you here?
The 30-second elevator pitch. I am a former pizza guy. I've been in business since 1994, almost as old as you are.
Yeah, really?
That's when I started the restaurant. I was 24 years old. I got out of college. Pops had a restaurant. I got into the restaurant business because I wanted to become an entrepreneur. Little did I know that I had a really great high-paying job for about 15 years. 2008 comes. I'm like, holy crap. I'm not making money here. What do I need to do? I met my business partner, Jake. He was the pharmaceutical rep. I was the pizza guy. He was taking catering orders out of the restaurant. Bringing them to his doctor's offices, selling vaccines. We had the genius idea of like, hey, let's get together and buy real estate. 2011, he moves to Knoxville, Tennessee. We partner up. We start buying deals in 2013. Yes, it took us 18 months to find the first deal. After 5 years, we've got, I don't know, 50, over 1,000 units. And to date, we've got over 1,800 units. We've got over $400 million in assets under management. And listen, those units are owned by us. We don't have any more syndication. So the equity is ours and ours alone. So it's been a pretty incredible ride, to be completely honest.
I bet. Wow, there's a lot to unpack there, and I don't even know where to begin. What were some of those things back in the day when you were there some fear? Was there ever like fear that went through your mind, and on that transition from the pizza world, the restaurant world, into real estate? And what were you thinking in those 18 months when you were looking for a deal and all that kind of stuff?
Fear goes through my mind every day. it sort of helps to calm me down a little bit because it makes you think for a second. And that fear never goes away, whether it's your first deal or your 30th deal. Now, fear may not hold me back on my 30th deal, although it should still be there. It's just a caution. Hey, should I be doing this deal? How do I limit my downside risk? Fear allows you to ask better questions. And the problem, I think, is that those of us that have fear and are gripped by it, really, it really limits our ability to think clearly, to make really great decisions. I was just fortunate to have an amazing wife. Listen, I've got 6 kids, so there's not much more fear in life. Oh, you got 6 kids, you got to feed them. That's why I wanted to get into real estate, because I'm like, I'm working harder, I'm making less. What's going on here? And one tip I'll give to the listeners, I'll give you 2, but the first one right now is, if you're going to get into business or you're going to get into real estate, you think you're doing it to support your family, to provide for yourself. That's the wrong answer. If you're going to start a business, you need to provide for your customer first. Then your customer will provide for you. I started that restaurant because I needed to make money. I needed a job. And great, maybe great in the short run, but when things get tough, the economy slows down. If you don't have a great customer base, if you're not providing value to your customers are going to go bye-bye. And that's what's happening with a lot of these big box stores. That's why when private equity comes in and takes over, customer service disappears. Private equity is only looking at their interests for the most part. Now, for Jake and myself, it's the same thing in real estate. You may think to yourself, hey, I'm going to get into real estate. It's all about my returns. No, it's about your residents that you serve. And if you're taking private money, it's about your investors. If you're not providing value to them and you're only thinking about yourself, you're going to be short-lived. That's the reality of being in business. Now, specifically to your question, 18 months, why did it take us so long? It's because we had no map in the beginning. We had no process. We figured out how to buy right, how to manage right, and how to finance right. That was our 3-step framework. And once you create a framework, something that's repeatable, something that you can go back to and say, hey, here are the guardrails. What is my criteria to buy? How am I financing this thing? And ultimately, what does it take to manage? And if we go back, Peter, back to 2011 when we started, everyone's going to tell you times were great to buy real estate. Why? Well, why didn't anybody buy real estate back in 2011? Because it was really difficult to finance real estate. It was really difficult to raise money back then. It was hard to find equity back then. So the deals were there, but it was really hard to finance. Fast forward to today, we're getting back into that time period where right now we're closing on a 68-unit deal. 6 months ago, it would have been a piece of cake to finance this deal. Now it's a lot more challenging. You need to come up with more money down. The terms aren't as good, and it's a lot harder to raise capital than it was a year or 2 ago. So it's very similar. So to me, I guess the second golden nugget I would tell everybody, now is the time to get into real estate. If you've been sitting on the sidelines, now is the time to get in, talk to investors, talk to real estate brokers, start doing property tours, start getting into the market, becoming an expert, because in the next 12 to 24 months, there will be opportunities. And if you're not prepared for those opportunities, they're going to pass you by. And I would say the last thing, anybody listening to this, if we go back 5 years to 2019 or 2020, how many of you wished they had invested in real estate 5 years ago? I'm going to guess probably 100% of you, all of you.
If you know anything, right, you should. Right?
So if you've got that sentiment, let's go and fast forward to the year 2030. You're in 2030. And you're saying to yourself, man, I wish I had gotten into real estate 5 years ago. Now's the opportunity. Don't wait for 5 years from now. Start planting seeds now. I forgot the term that James Clear uses in the book. I think he calls the aggregate of marginal returns, the aggregation of marginal returns. Everyone thinks that, man, they got to burn the ships. They got to go full steam ahead. They got to jump into something and they got to take massive action. That really doesn't work. That ends up burning most people out. Sure. Jake and I did for the 18 months, we took little marginal returns. We did little work every day, that 1% every day, calling a broker, learning how to underwrite, learning how to do a market property tour, learning how to analyze the market, right? Putting in an LOI. These things we're not taught, right? We have to learn them ourselves. And if you're going to try to do everything at once and try to take this massive action all at once, you're going to become overwhelmed. So just take your time. Rome wasn't built in a year. If you think about the next 12 months of dedicating to this craft, and then after 18 months, you buy your first deal. And for Jake and myself, by month 24, we've got 200 units under contract and close. So you're saying the first 18 months, nothing, nothing, nothing. Then all of a sudden you got that hockey stick because we've taken massive action. That's why people become successful. They have the discipline to stick with it and to say to themselves, I'm not going to quit because I know what I want, right? I've got the clarity. So I've got the motivation to do it, but I just got to take these little steps every day. Just show up every day. And if you need somebody to be there with you, you need an accountability partner, go out and find a partner. Because I was fortunate to have Jake as my business partner. So when times are tough and I'm sitting in the basement by myself, month 12, going, Jake, we don't have anything. He's like, bro, let's just keep looking. Something's going to pop. I had somebody to talk it through. And that's, I think, what helped me out early on, Peter.
Wow, you just dropped so many golden nuggets there. And some of the questions I was going to ask you, too, you're ahead of the game. But I think what you're saying is the compounding effect is not just a monetary thing. You know, I mean, it goes towards other actions in your life. I mean, if you're doing these little things towards your goal every day, that's compounding day in and day out. And then just like the compounding effect, it doesn't seem like a lot in the beginning, but as time goes on, you start to get those massive returns on investment over time when you're consistent and just put it in every day. There's different types of ways to invest. And obviously this is the accredited investor only podcast. The audience tends to be more on the passive side of accredited investors. But there's also people that want to be active. What's your advice to somebody who wants to be active? Obviously you understand both sides of the business. You're doing what you're doing from a very active perspective, buying deals and all that. And then it sounds like you're working with a lot of investors, on the passive side too. What would you say, like, if you don't know what you want to be, or you think, a lot of doctors think, they control freaks, and I mean, they want to get into this and that, but then they maybe realize over time, this isn't as easy, as I think it's going to be. I mean, you got to wear a lot of different hats and stuff like that. What would be your advice to people that want to get in, but they're not sure, should they be active? Should they be passive? What do they need to know? What do they need to be thinking?
That is an excellent question. I'm going to go over the 3-step framework for passive investing, because I think once you get that nailed and you start thinking about that, okay, I understand how to invest passively. The first thing that anybody needs to do when they're listening to this is understand their relationship with money, what the psychology of money is to them, and what their money persona is. I can't go through it. It's in our book, Happy Money, Happy Family, Happy Legacy. That's the first part. Start out with what your goals are. For me, early on, I knew that I wanted to be active because I wanted to get out of my W-2/restaurant. That was the goal for me. But I didn't burn the bridge. It took me about 5 years. In 2011, I started with Jake. In March of 2016, I left. So I gave myself a runway. All of the money that I made in real estate, I reinvested it back into the real estate. The restaurant was paying my bills. So was it difficult? For a couple of years, it was really hard. I've got kids. I'm homeschooling the kids. I've got the restaurant 50 hours a week. I've got the real estate, but I needed the restaurant income to actually help me qualify for loans, to actually, the cash flow that I'm making, the refinances that I'm getting, I'm putting it back in. So the first step, if you're listening to this and you're saying, should I go active or should I go passive? If you're doing really well with your job, you like your job, you need to just put some money on the side. Hey, say to yourself, let me start out passively. I think passively is okay. Let me go out and find some qualified sponsors, but I need to learn the business. I just don't want to hand my money over. A lot of limited partners and passive investors have done that over the last 5-6 years. It was going great. Nobody was complaining until the Maserati Mikes of the world show up. And a Maserati Mike is simply a guy driving a gold Maserati, shows up at my restaurant in 2005 and says, Gino, I've got a deal. Remember 2005, a lot of cash, a lot of money flowing around, right? A lot of risk. But I'm like, I got money, Mike. Sure. What do you got? He's got a mobile home park. All right. I'll give you my money. 18 months later, make a long story short, Maserati Mike drove away with the money. And it's not even that he drove away. He just got foreclosed on. The problem was that he had no skin in the game, so nothing happened to him, but I lost all of my capital. So if you're listening to this and you're a high-income earner, I would really join a mentorship group, join somebody out there, learn the business, learn how to underwrite, or at the very least, get a coach who can understand underwriting. So when you start looking at deals, you can put it over to them and say, how does this look? Does this make sense? I mean, are these assumptions accurate? Are they conservative? Understand the underwriting. Now, the 3-step framework is really important, Peter, because when you're looking at this framework, the first step, we call it the jockey. Think about somebody who's a jockey who's riding a horse. The jockey's got the hat on. That's the sponsor. That's the very first thing that you should be looking for when you're looking at a passive investment. What most investors do when they start out, when they're new, they're looking at deals.
Yeah.
I got to put money in a deal. I'm a deal junkie. I need to find the highest IRR. That's the complete opposite. That's what I was doing with Maserati Mike. All I was doing was looking for a return. I should have been looking for a qualified sponsor, and we can go through what that looks like. But to keep it short, a qualified sponsor is somebody who's been in the business, I would say, for at least a market cycle, who's had investors, who's even made mistakes, but who's can go back and have that great conversation with you and let you know, yes, I did this, who can lay out their business plan, who can actually walk you through a deal and take time with you on the deal, right? That's the first part, the qualified sponsor. The second part of the framework is what I call the saddle. Now, the sponsor is sitting on the saddle. That saddle is called the alignment of interests. Your interests as a passive investor have to align with the sponsors. Now, going back to Maserati Mike, our interests did not align because Maserati Mike had no skin in the game. When the deal went bad, he had nothing to lose, right? Alignment of interests. If you're going to invest in real estate as a credit investor, you need to understand there's a lot of risk. Maserati Mike never went over the risk. He's like, hey, this real estate, I've owned it for years. No problem. You're going to get your money back in 2 years.
up.
When you hear the guarantee word, just please don't walk away. Run, okay?
Yeah.
Understanding that your capital will probably be there for a minimum of 3 years, if not longer. It's interesting. It's important to understanding what the fees are. Now, I have nothing against fees, acquisition fees, asset management fees, property management fees, disposition fees. Are they feeing you to death? That's what you need to understand with the coach and saying, hey, are they actually over-raising on this deal and then giving it back to the investors as return of, capital, or is they calling it cash flow? Understanding these little nuances is important. So your interests need to align with the sponsor's interests. And I think the third one is the deal itself, is the horse. Now, the horse is all about buy right, manage right, and finance right. That's really about the deal itself. And as a passive investor, and even an active investor, just as an investor in real estate, you need to understand that investing in real estate is investing in a business. And if you don't understand that, if you don't understand that you're becoming an entrepreneur once you're investing in real estate, please don't invest in real estate. That's one of the best, to me, advantages. You're buying a business that's scalable, that has multiple tax advantages, that is a basic human need, that has your residents paying down your debt. I mean, there's so many amazing benefits to it, but understanding that there is a component where you're going to have to manage this asset full time. And if it's not you managing it, someone's going to be managing it for you. This is not a stock where you're putting money into a mutual fund and you're going to bed and saying goodnight. That's not what this is. But I mean, it's, risk versus reward. You're going to get rewarded a lot more handsomely by investing in real estate as opposed to investing in stocks. You have more control. So for you to understand the framework, always look at the sponsor. Try to vet that sponsor. The second part is, do your interests align? If they're doing self-storage and you like apartments, interests don't align. If they're in Columbus, Ohio, but you only want to invest in the Southeast, your interests don't align. If you want to get a 10%, cash on cash return, and they can only offer a 5%, your interests don't align. And finally, understanding the business of the buy right, the manage right, the finance right, who they have on their team, who's their CPA, who is actually their real estate broker, who's their syndication attorney. All these questions about their team is really important.
Yeah. When you put it that way, it makes so much sense. And it's so simple. It's 3 steps, but it is complex. There's a lot of parts to that. And that's where it really starts to make sense what you were saying before about kind of the compounding of doing little things each day. Because if you try to do that in a weekend, it's just too intimidating. It's way too much. Where would you say somebody should get started when it comes to that?
That's a great question. I could say, hey, go to Jake and Gino. You can go listen to our podcast. I've got how-to podcasts every week we launch. I've been doing a how-to show for the last probably 2.5 years. If you go and listen to our how-to show, it's a 12-minute show. You could probably end up buying a multifamily from that how-to show. But if you're just beginning, go to Bigger Pockets. I mean, I don't like the company as much as I did years ago, but they are the premier platform out there for open source content. Go on there, go on all of their forums, go listen to their podcasts, read some of their books that they have out there, and just start chatting with other people online and start getting information. But I don't want you to stop there because that's where most people stop. They stop, hey, that's great. I don't really need the education. There's two ways you're going to learn in this world. You're either going to learn on the street or in the classroom. I learned on the street when Maserati Mike pulled in and he said, hey, Gino, give me the money. Learning on the street's expensive, time consuming. I think you need a mixture of both. You should be able to learn on the street, but you also need to sit down and find a mentor who's done it. Find someone who's done what you want to do. There's so many people out there that have done the business, done what you want to do. Go find someone that you like. Go find someone that's put a program together and start following their program along with following stuff online, whether it's Bigger Pockets, whether it's other people in the multifamily space. And if you're into single family homes, there's a ton of guys out there who do the single family home space as well.
Sure. Well, I think you're hitting the nail on the head because if you're serious about this and you want to do this full time, you want to do it in the background, but you want to do it right, that kind of thing, you got to be able to spend some money, right? It's not going to be free, right? These courses, it takes a lot of time to do that. And like we're saying, there's a lot that goes into that. People, I think, especially accredited investors sometimes, they didn't get that way, spend the money. I always think it's funny, people think, that because you have a lot of money or something like that, you're going to, want to, you could spend money on a $30,000 course or something like that. And a lot of accredited investors aren't that way. They're very conservative with their money. Another, I think like a good the way to equate that is like I've done commercial real estate where like you have you're representing maybe like a Taco Bell or Wawa or Chick-fil-A or something like that. And people think, well, they'll just pay anything. If you're the owner of the building, you think, oh, they'll be able to pay that. And it's like, no, they didn't become that large just paying anything. They're actually probably the worst when it comes to that. They know exactly what the data says. They spend a lot of money on getting that data, and they know how much business is going to go through that store because of traffic and location and demographics. So they know we can only pay this much and we're not paying a dime more than it. And I think it's important that accredited investors look at it that way as well, right? They have to. There's a cost associated with learning all this kind of stuff, right? We pay to go to college and high school and different places and all. What's your opinion on that?
So we pay to go to college to get a useless degree, get debt that almost half of the student debt out there. Kids don't have college degrees. That's sure. The real travesty. And the other travesty is they're getting degrees and not learning basic skills. If you're not going to college to learn how to publicly speak / communicate, if you're not learning how to negotiate like Chris fought, if you're not learning how to set goals, if you're not learning about investing your money, then you're wasting your time in college. It's great to have a well-rounded college degree. It's great to have a liberal arts degree, but you need to be a critical thinker. They're not teaching critical thinking. That's the sin of what I see is going on in college. And those skills that I just said to you, if you can learn, and let me add another one, if you can learn a little bit about sales, a little bit about critical thinking, a little bit about communication, because to communicate your thoughts and to persuade people, that's what we're doing in real estate. You're persuading someone to invest in you, not in your deal. Because your deal could have a 25 IRR. Why am I going with somebody with a 15 IRR? Because I like that person, because that person communicated with me better. He described something to me a lot clearer than what this other person did. So for me, I love education. And I think people who are accredited, who are more savvy, understand that education is an investment. It's not an expense. I used to think at your age that it was an expense. I couldn't afford it. Now I've realized that I cannot afford it. And I can give you a couple examples of where I've used it in our business. I mean, for us to scale a company from 500 units to 1,800 units, it just doesn't happen because I'm a genius. It happens because I've spent hundreds of thousands of dollars on traction, on EOS, on scaling up with Vern Harnish's company. We need how to scale a company. Yeah. You need to learn how to do that. And then obviously you're going to bring on property management executives to help you scale your property management company. You're going to bring on marketing executives to help you scale that side of the business. So for you to sit out there and say, hey, I got to do it by myself, multifamily is a team sport, number one. And number two, when you really look at all of the people who are super successful in this world, they've all have multiple coaches / mentors / partners that have helped him get to where they are.
Yeah. Well, I haven't thought of scaling up in a long time. The first company I started to work for after school, they got pretty heavy into scaling up with Vern Harnish and all. And it was one of those things. I'm curious to hear your take. Uh, how important it's important doing it in your business, like you just said. How important do you think doing that kind of stuff? And I want you to explain it to the audience
Sure.
what scaling up is, but doing it in your own personal life. Don't you think to yourself? I'm sure you talk to a lot of investors. Don't you think to yourself if they did what you do with scaling up and all the BHAGs and goals and all the kind of introspection on what you're doing in your business and all that, if you did that in your investing, how successful would people be?
Brother, I had one restaurant for 22 years. One restaurant location. Couldn't scale. Didn't even know what the word scale meant. Within 5 years, like I said, Jake and I owned over 1,000 units. What was the difference? I don't know other than the fact that we had core values, mission statement, and we had clarity. And we were actually going through that process. When you have your core values laid out, when you have your mission statement laid out, when you have your culture built within your organization, and this is interesting what you said, personal. If you have a family and you start looking at your family as if you're running a business, they're very similar. Your family has values. You should have what we call values-based decision-making. All of your decisions should be based upon your values. What are you investing in? I invest in real estate because my values are long-termism, control, opting out of the system, creating wealth long-term, having a long-term mindset. Well, that lays itself well with real estate and with multifamily. So every decision that I based on my investment goals goes towards that. Now, our core values, people first, make it happen, extreme ownership, unwavering ethics, and growth mindset. Back at the restaurant, I would hire somebody, had no path, no guidance. Every time there was a problem, it was their fault. I wasn't the leader. I never gave them any guidance. I didn't have any values to share with them. I wasn't actually building a business. It was all dependent upon me. So for anybody to go out there and say, I'm going to do it by myself, you could probably do it and buy a few properties, or you could probably invest in a couple of mutual funds. My question is, should you be even using those vehicles? Do you even know what your values are? Do you know what your goals are? Goals are just a result, right? That's the problem. Goals are the result. We only try to focus on the goals. Try to focus, as James Clear says, on the systems or the processes. Fall in love with those. Because if you fall in love with that stuff, if you fall in love with underwriting, and if you fall in love with walking properties, and if you fall in love with talking to brokers, inevitably you will start closing deals. But understanding that the values plays into it, because like I said, if you're a junkie where you like to have action and you like to see things moving all the time, multifamily is not it for you. We do 2 or 3 deals a year. That's a lot.
Sure.
But with those 2 or 3 deals a year, I make a lot more money than 99.9% of the population because they're the right deals and we know how to create value in those deals. So understanding that and being clear on that, what you're talking about is building the foundation. I'm talking about that's the financial foundation you're building on. And if you don't get clear on that, don't start chasing returns. Don't start putting money into any venture until you understand what the core values are for you, where you want to direct your money, and ultimately what you want your money to go into and what you want it to grow into, and then what you as an individual want to become in the next 5 to 10 years. That's really important.
Yeah. Yeah. And you're hitting the nail on the head. Yeah, man. I completely agree with you. And I think it's one of those things it's so basic, it's so foundational. You use the foundation word that people forget about it. You just you step right over. You know what I mean? It's like,
Peter, we don't know about it. I'm sorry. It's like, because like I said, once again, we were never taught this in college. Like everyone thinks that, Steve Jobs was this genius and he just figured it out. And you have Michael Dell and you have Zuckerberg and you have Elon Musk. Elon Musk is in his 50s. He's been in business for like 30 years of his life.
Yep.
I mean, that's the compound effect, making mistakes, selling a business, sleeping on a factory floor, understanding what it takes to make payroll. These are all things you learn. And I think scaling a company is the same way. If you've never done it before, if you've never bought a multifamily property and try to buy another one, this is something where you have to actually invest in your education. And if you don't, you're going to get stuck. You're going to become the I'm a guy. I'm going to do this. I'm going to do that. And IMA gets burned out after a while.
Yeah, that's a really good point. God, well, you're dropping a lot of golden nuggets here, and there's so many things going through my mind. I was taking some notes uh, to try to remember because I have so many questions for you. But while I'm thinking, talk to me about the book. You mentioned you have a book there you were showing. Is it talk about a lot of the stuff we're talking about now? Is there other things that the book gets into that we haven't discussed yet? Or
I think one of the main themes that I really touched upon over the last 6 months of my life, as far as one of the reasons why I wrote the book. Well, there's two. One was the legacy component. I think most people have the legacy component mixed up, especially myself. But the other one was, as I'm starting the Jake and Gino platform back in 2016, I start seeing students who are successful, who have no business being successful. They're young, they have no money, they have no credit, and they're closing deals. And then I have students who have capital, who have experience, and they're not closing deals.
Mm.
And I'm saying to myself, what's the difference here? I mean, obviously, it dawned on me, it's mindset. But even more than mindset, to me, it came down to the relationship with money.
Mm.
And once I understood that, I was like, wow, that person has a terrible relationship with money. They sort of hate money. They sort of, it's just when you talk about it, and how can you understand your relationship with money? And I had to do a lot of work on this myself. You go back into your childhood, and what do you hear about money? A lot of people have limiting beliefs about money. I heard that, hey, you have to save for a rainy day. It's hard. It takes money to make money. Money doesn't grow on trees. So if you have that kind of mentality, as you're getting into the investing space, everything's a problem. There's no opportunities. There's only challenges. So that person, that mindset, that relationship with money is going to be a lot more challenging. I had to work through that. Once I understood, wow, you don't need money to make money. I've done over $20 million of seller finance deals. I've done over $20 million in syndicated deals using other people's money. Once you start exploring your relationship with money and understanding what money really is, money is just a tool. And the happiness that you derive from money is not the money itself. It's the autonomy that money creates. It's, hey, I want to be on a podcast with Peter today at 4:00. I can do that because I have autonomy over my time.
Sure.
And understanding what happy money is. I interviewed Ken Honda from Japan. He wrote the original book, Happy Money. He had, over 8 million copies sold. And he said to me after the podcast in his Japanese, little slang, he goes, Gino, you need to write happy money, happy properties, happy family. And I said, Peter, I don't want to write another book on real estate. I want to write one with family, money, but also legacy. And to tie the legacy component up, as you're getting older, understanding what legacy looks like, you're trying to teach your family to become a financial steward, but you're not only bequeathing your financial assets, you're also giving away, or you're also hoping that your values shift to the next generation, right? That's to me, that's really important. And I think that's what's important to a lot of entrepreneurs, right? And the other component is, if I say to myself that my values are responsibility and control and being in control, how can I leave the next generation, my kids, in a worse situation if my legacy is not at least wrapped up? I don't want to leave my kids a mess where all of a sudden they're going to be fighting about the assets.
Sure.
You're not going to know how to control the assets. They're not going to know how to invest. So with my legacy, a component of it is that we've created a company called Barbaro 360. That's where me and the kids all got together. We're creating this platform where we're actually teaching people about money, teaching people about health, wellness, faith, family. That's part of the legacy. And I think people, when they think about legacy, they default strictly just to the financial aspect of it. And that's not, to me, not the most important component. The most important component is to prepare the next generation, their legacy, and to prepare them for whether it's financial, whether it's values, to be able to, once they get it, it's going to be a burden to them. They need to be prepared to take that burden on.
Yeah. We were talking politics before we started the interview. And one thing I always shocks me with Trump is the fact that all of his kids are successful. They're not drug addicts. They don't have 10 different wives and things like that. They may have one of them has some girlfriends and things like that. But it's somehow he seems to have been able to pass on those certain values to the kids. What is it? What do you think the challenges are? Some people really some families have a really hard time with that. Where people run into drug problems and things like that. What would be the advice for somebody that wants to pass that along to their children? When should they get started, and what should that look like?
So that's interesting. I don't want to make this joke, but it needs to be made because I think when you see one president who has a kid on a laptop and gets in trouble, and you say to yourself, the one word that comes to mind is entitled.
Yeah.
And you see this going on in the country right now and in our negotiations right now. When one side feels entitled, if your children feel entitled as if they are expected to receive that money, it's over. Like you have not done your job. You need to be part of their lives. You need to be there for them, right? It's also the whole slogan for me is you need to prepare the child for the road, not the road for the child. I think as far as what you're seeing with Trump's kids, no one's perfect. I mean, like your kids can't be perfect, but the fact that they aren't in all of, as far as like the scrutiny that he's gotten, they seem like they're pretty damn good kids. They seem like they run their businesses really well. They seem like they have amazing families themselves. I think for him, family must be important. It's just, I mean, as far as his personal life with his wives and ex-wives, that's a different story. But I'm talking about with his children.
Yeah, it was a good
he's had a good relationship with them, and I think you need to spend quality time. I think you need to set boundaries as a parent. I think you need to say what you do and do what you say. I think as far as a parent, also. You need to be transparent and honest, and you need to be able to speak to them about money. I'm sure the dinner table had a lot of conversations about the Trump family saying, hey, when are we doing another deal? Dad, how are we going to raise the money for this deal? That was the conversation there. Not, hey, are we going to pay the bills? Or, hey, we have to save. It was the conversation that he was having. And if you're listening to this, you can start today by having open and honest conversations with your kids. I was telling my kids when we were struggling with money, hey, this is what's going on. If you're hiding it from them and you're avoiding the topic, they're going to grow up to avoid the topic of money. When a bill comes due, they're going to avoid paying the bill. When a big decision comes to make, buy a home or invest their money, they're going to feel paralyzed.
Yeah.
And that's challenging as a parent. So for you, and they know it, they can sense it. So to me, that having that conversation with your children about money, why are you going to work? How are you going to save for your money? What are you going to do with your money when you get older? These are conversations that you need to have with your family. Have roundtables. Sit down for dinner at nighttime. Shut off the devices and just have those open and honest conversations. I've got a deal going on right now. My kids all invest in my deals. They know what the conversations are like. We have quarterly meetings with our bookkeeper because they all have businesses. So getting them, and Peter, once again, you don't need to overwhelm them. That marginal return, that little bit every day, that's all it takes. Before you know it, at the end of the year, you're having quarterly meetings with the bookkeeper. They're doing their sales tax returns. They're doing their own K-1s. They've got their own LLCs formed. It's like, how did that happen? It happened because I was just being consistent with them.
Yeah. I think they're going to pick up on, your attitude towards it and the things that you say too. I think I've had friends growing up where, and there's a couple of people I can just close my eyes and think of it where their parents hated their jobs. They hated work, and they were just working for
unhappy money. That's what that is. It's unhappy money. It's negative energy. It's scarcity. It's fear. Peter, I didn't mean to cut you off, but that's where I was at the restaurant. That's why I needed to get out. That's why you said, well, what do you want to do with real estate? I needed to do something because I knew I didn't know back then. I know now that I'm looking back, I was in that unhappy mode of just having to go to work at a job that I didn't like. It wasn't my sole purpose. It wasn't my passion. I needed to find something different. And I knew that real estate was the avenue. So if you're out there saying to yourself, hey, you know what? I really don't like my job. I really need to find something else. Go look for that something else. While you're making unhappy money, dream of what happy money looks like for you. And whatever pops up in your mind, start focusing on that picture and putting your energy towards that as well.
Yeah. Well, that's going to be contagious. Yeah, I mean, because not only your friends, your family, your spouse, the people around you, your kids are going to pick up on that. You know what I mean? Because if you hate money and you hate your job, you hate that kind of stuff, like I know people, I can think of a few examples where they grew up and now they hate what they do. I mean, they've kind of just it's like a cycle. You know what I mean? Whereas if somebody is at home and they see their parents love what they do, I mean, that there was a lot of enjoyment. It wasn't just about making money, but it was also enjoying what they do, all that kind of stuff. I think that's contagious, and that goes, that goes a long way. And that's where it just comes back to, it's like you have to get this right yourself, right? Before you can do it like for other people and stuff like that, right? It's just, Yeah, and that's where I come back to. I just think it's so important that the kinds of things that you're doing in your business or that you do at work, and, ideally for the company that you work for, that kind of thing. If you do that, uh, to be able to do those in your personal life just goes such a long way. And I think that's just something that so many people miss, and it can really be life changing. And it's something you mentioned in the beginning, the perception, of looking at it not so much about yourself, but your customer. And
Mhm.
if you're an accredited investor and you're investing passively, then in a lot of ways, your customer is your family, right? It is your kids and who you're investing for. Would you agree with that?
Yes, and well, you're the credit investor. They're your kids, but you're the customer of. So then you're the customer of the person that's getting the money from. So
Yeah.
that person, if I'm raising money from you, who's an accredited investor, you're my customer. That's important to understand as well. But you said, I think, back about 3 minutes ago, you said, I think, if you're in a job, it's contagious, and
Mhm.
I don't think I know when I was stuck at the job that I didn't like. I know when I came home, I didn't want my kids to grow up equating hard work
Mhm.
and a job with pain and not liking it. I
Mhm.
did not want to do that. So I knew that I had to exit that some way or the other, because them equating hard work and stress and making money, I didn't want them to have that mental picture, because if they grew up, they're gonna be like, well, dad didn't like his job. I don't know if I'm gonna like my job. Dad had unhappy money. And that subconsciously goes through. And now the kids know that I love writing books. I love investing in real estate. I love doing the events. They know that I love it, and they see that, hey, work can be fun. My eldest daughter is a missionary. She's into art. She loves that. My second child, he's 22 years old. He has his FFL license, federal
Mm.
farmer's license. He loves that. He invests. My 19-year-old, she's a massage therapist. She loves medical massage. She loves what she does. So they're on the path. As a parent, it's not your job to choose to them what you think they like. They have to choose their own path. You have to give them the grace and the space to figure that out, and not there to dictate, to tell them what to do. You have to let them understand what happy money is and what they think they're here for, what their sole purpose is, and what their passion is. And if they show up every day, give them 4, 5, 6 years. By the time they're in their 30s, they're going to be doing phenomenal, because they're going to love what they do, and they're going to impact the world in so many more ways than you can imagine.
Yeah. Yeah, that's gold. Well, there's something you mentioned earlier about, that I wanted to get back to, and I don't typically like to talk a lot of politics, but it's one of those things you can't get away from in business. They're related, right? I mean, I've had investors tell me, I don't follow the news or anything like that. I just think, how the hell are you investing and not following the news? Yeah, there's things that happen in the political world that have an effect, and there's obviously been a lot right now coming off of the last year and the election and things like that, and then now with different things happening with tariffs and where's inflation, interest rates, and all that kind of stuff. And you were saying now's the time to be investing. And you mentioned thinking of were you investing back in 2020, 2021? Did you wish you were, that kind of thing, and kind of zooming out to 2030. And I think right now where there's uncertainties, there's things happening and there's things at play right now that people are uncertain how it's going to play out, all that kind of stuff. How do you get past some of those uncertainties? Because I think the uncertainties tend to lead to inaction for a lot of people, right? You know what I mean? They don't know where this is going to go, that's going to go, so they just kind of stay on the sideline. But to your point, you think now is a great time to be investing in real estate. What do you think? What's your thoughts on that? I mean, how do you people get past that and all?
It would
How do
be
you
my
guys?
hope. Yeah, it would be my hope that anybody listening to this would at least be open-minded to discuss politics and the other topic of religion.
Mm.
We can agree to disagree. If you want to be a really top-notch investor, if you want to be a really top-notch human being, you need to hear all sides. The problem
Sure.
is that people have a paradigm. They look through that paradigm and they get blinded by pride and by ego, and they want to be right.
Mm.
As you get older, you don't want to be right as you get older. You just want to have the right answer. And if your answer is better than mine, great. But if you're only listening to one side of the story and that's all you hear, and you don't step out and listen to the other side, you're truly ignorant. And if you're an accredited investor, or you're an investor and you're only listening to one side of the news and not the other, and not trying to take the bigger picture, as far as tariffs go, give me a break. Tariffs are just being used as a tool to get investment back into this country.
Mm.
Apple, Honda, AI, have they just announced billions of dollars of reinvestment in this country?
Sure.
Don't we have all the negotiation power where we could say, hey, trade is not free. It has never been free. We have wielded our power because the politicians have gotten wealthy off of it. They haven't negotiated properly. We finally have somebody who just wants to make deals. Let's go back and make deals. So I'm looking at this not at the next 2, 3, 4, 5, 6 months. I'm trying to take a longer term outlook because as you see, there's a lot of volatility in the short run, and that's okay for me. As a real estate investor, cost of capital is higher now than it was 2 or 3 years ago. Deals still have to make sense at this cost of capital. Interest rates, when inflation gets under control, and hopefully they can start eliminating a lot of this spending, because the real crime to me is what's going on with Doge. Every single American should be on board with us trying to cut the $2 trillion a year in spending. Because if you want to get rid of inflation, you get rid of all that wasteful spending. You can lower taxes, or at least keep them baseline. You stop printing money. Inflation goes away. Interest rates come down. The economy gets spurred. It's very simple. And the fact that we're having people complain about Doge, to me, is mind-boggling. But if you as an investor should be cheering, let's cut this wasteful spending. Let's find out what agencies we do need, which ones we don't need. That shouldn't be a political statement. That should be basically, you're taking my money and everyone else's money and you're willfully spending it. Let's try to figure out how we can cut the spending. If we can cut the spending, we can take care of the inflation problem. And once that problem is gone, we lower interest rates, growth comes back. And between the growth, lower interest rates, and the spurred economy, that will help with the deficit. That will help with asset prices. That will help with everything. But when if you can't understand that at a base level and you're only an ideologue, that's the problem that we have nowadays. We need to work together to try to limit the size of government, to try to get them out of a lot of businesses. All you need to do is look and see where the flow of population is going. 30 years ago, I'm from New York. Everyone is going up to the Northeast in California because those were the areas where there were universities and the population was very well educated. You had an educated workforce. Well, that's flipped. Now the Southeast and the Sun Belt and the Midwest is where the population are going. And understanding that from demographics, I'm bringing this back to the investor. That's where you should be looking to invest. There's the cost of living is a lot cheaper. You have a lot of population. You have a lot of job growth. And those are the areas that I would be focusing on if you're going to be investing in real estate.
Yeah. Wow. So many golden nuggets there. And I think you hit the nail on the head when it comes to, just reading both sides of the spectrum, man. I mean, and not getting too tied up into any one thing and being open-minded. And that's where I think, like what you talked about before with finding a mentor, and a lot of times mentors come along with communities and things like that, to be able to talk to people and listen to different opinions and different sides and all that kind of stuff. I think it goes a long way, because there's always, if you keep an open mind and you listen to people, you might not agree with everything, but a lot of times I find that they'll say things that make sense, you know what I mean? Or it clicks, you know what I mean? And it's one of those things where, I never thought of it that way or something like that. And people are in different parts of their life. They're in different businesses. They're in different parts of the country. So I think that kind of goes back to some of the things we were talking about before, where it's just like, if you can find a community and you can actually have conversations, and not just get so buried into articles and things like that tend to have an agenda, that kind of thing, but actually have conversations with people in real life that are actually doing things, and then start to devise your opinions and things like that from there, and then, make decisions based off of that. But I think that kind of goes back to some of the stuff you were saying before, where it's just, you can't isolate yourself in this business as an investor and get too closed-minded. You really got to, think about things from all different angles and talk to different people and all.
I agree wholeheartedly, and I'm not telling you to go on Instagram and find a follower and listen to that person. Just go find people who've been in the business for a decade or two. Success leaves clues. And with this time, start digging in. And if you're going to be investing with somebody and you get what's called a private placement memorandum, don't cheapo. Go out and find an attorney. Let the attorney read it to you for $500. Let them poke holes. I've had so many students join our community afterwards and going, I can't believe I invested this. I said, well, did you have a contract? Yes. Did you have an attorney look at it? No. And I'm like, that's why, because we're trying to be penny wise and pound foolish. And it's like, you know what? It's okay. If there's something you don't understand, find somebody who's done it before. Don't be afraid to pay for that because, hey, you're saving $500, but you put $100,000 into the deal. Does it make sense? You're going to pay for it
either way, right?
Yes, that's right.
You'd rather not pay for it in a mistake that leads to probably a worthy experience and something you learn from. But if you can learn from other people's mistakes as much as possible, that's always not a bad way to do it. And a lot of times you have to pay for that.
Smart people learn from their own mistakes.
No.
Wise people learn from others. There are very, very, very few wise people in the world because it's difficult. You need to experience that pain at certain times. But hopefully, starting out in real estate, you start out small, you make some mistakes, you can weather the storm. I started out with that small deal even before Maserati Mike, made a couple of mistakes. Then Maserati Mike came along. It was a big enough mistake, but it didn't take me out completely. And I actually, what was great about it with me was I had enough pain in my life that I didn't let that stop me. I had the 2008 Great Recession coming and say, I need to figure this out. I need to find something else. That was my motivating factor that I actually didn't quit. I'm like, hey, dude, I need to figure this out. Reading T. Harv Eker's book, start getting into personal development, start getting into life coaching. I'm like, wow, this has been my mistake all along. I blame Maserati Mike. It was his fault. He's a dirtbag, but ultimately the responsibility lies within myself.
That's right.
And if you can't grapple that, and if you are ultimately the victim your entire life, I can't help you. Nobody can help you. And I can say that unequivocally because I was a victim until I read T. Harv Eker's book. And I said, wow, being the victim may be great. You may need to do that for a little while. You may need to grieve. But I will guarantee you, victims, what do? They attract other victims, and all of a sudden they start crying in their own bowl, and there's no solutions because all you see is problems. And once I understood that I had the responsibility, all the actions that I took up until that point of reading that book led me to where I was. Once that dawned on me, the reality of that, wow, that was challenging. That was a hard pill to swallow, but that was the pill that I needed to swallow. And I said, what's the next step? The next step was going out and finding a mentor.
Yeah. Wow. You hit that on the head. I was really fortunate when I got into this business that I was handed it was like two different materials at the same time. And one was Rich Dad, Poor Dad, and which led me down a whole path of different, ways of thinking differently about money and stuff like that. And the other was the Earl Nightingale's The Secret. And,
oh, yeah.
Just thinking differently. I mean, so it was like the financial development and the personal development. And when you put the two of those together, magic can really happen. So, well, this has been a great conversation, Gino. There's so many golden nuggets. I mean, this is one that I will look forward to going back and listening to and taking notes on. People that want to learn more about you and some of the resources you mentioned throughout the show, your podcast, the books, how can they find out more about you?
Just go to jakeandgino.com. The other website is Barbaro, Barbaro 360.com, Barbaro360.com. I got the Happy Money book on there. You can go on Amazon. We've got a bunch of podcasts on the Jake and Gino channel as well. And like you said, Peter, I think it's a two-headed strategy. You need to be working on yourself personally, but you also need to start learning about finances as well. Your language becomes your experience. If you start learning the lingo of finance and money and personal development, all of a sudden that becomes your experience in life.
Awesome. Gino, thank you so much for being here. This is a great conversation.
Thanks, brother. Appreciate it.